Hey, my name is John. Welcome to Cash Flow Veteran Podcast, episode 39. Why a first lien position HELOC is better than a VA mortgage. Now, I want to get into it, but I just want to give you guys kind of an update overall. My family and I, we have finally moved. My wife got a new assignment and we're in Colorado Springs. So it's been a little bit just of a crazy time moving, getting a new job, all that stuff. On the job front, I'm also happy to report I actually took a job as an independent contractor, but specifically a real estate agent here in Colorado Springs. And not just any agent, but one that works specifically for an investment brokerage, meaning that I work directly with single family homes and smaller multifamily homes to get deals done, to get them to a pool of investors, basically creating a marketplace for investors. And so my job as an acquisitions agent is to go out and find those properties to fill that pipeline. And that way, the hundreds to thousands of investors that we have here locally and across the nation have the ability to have access to those deals. And because I'm an agent, there's a lot more accountability and transparency that comes along with it. So I am a Colorado real estate agent with a company called New Western. If you have any questions about that, any sort of ideas or thoughts or interest in being a real estate investor that would like access to some of those properties, just reach out to me. You can to my New Western email that's there. So john.payne@newwestern.com. And also, if you have a line on any properties that are here in Colorado Springs, I certainly would appreciate that as well. So I've been doing it for about 2 months and I finally feel like I'm home. It's been a long time since I felt like I was in a position that I was meant to be in. While I worked with a group of people in Stratcom, I certainly didn't want to necessarily be working for the government. And it did help that I worked with people that were a great part of the team. And the people that I worked with were phenomenal. They were great. They made it very, very enjoyable, but I still had that philosophical itch to not be in the military or working for the military or the government in any fashion. So I'm finally out in the sales and marketing world again, but in an industry that I absolutely love. And if you know me personally at all, if you're listening to this and you go all the way back to my days as a missileer in Malmstrom Air Force Base, Montana, I've been talking about real estate investing and been dabbling for years and years. I've been reading and researching and everything, but essentially letting analysis paralysis take over and taking some action, but not really any action that yields any significant results, because I always had kind of 1 foot in, 1 foot out of the military and the civilian world. And, there's not a lot of people that are in the military that are investors that you're always around. You have to really go out and find some of those people. Now, there are some really, really good programs for getting into real estate while they're out there. But during that time, I found a company called Replace Your Mortgage. At the time, they are now Replace Your University. They've really expanded the brand overall. I am not just an affiliate of theirs, and I'll have an affiliate link for you if you want more information from them to go check them out. I highly, highly recommend you doing so. And that's kind of the basis of this episode, is to kind of dig into a home equity line of credit or a HELOC calculator and kind of explain from a number standpoint why I think the HELOC, first lien position HELOC, the way that they teach it, which is key, is superior to a VA loan and getting into a property. Now, we certainly have used VA loans for ourselves, and I'll go into where I think the VA loan might be a superior product and why someone should use a VA loan, especially from an investment standpoint. But when we're talking about people who are just buying a home because it's for something for them to live in, I don't think, and if you've listened to any other podcasts that talk about real estate investing, I'll have made quite a few comments that specifically talk about the VA loan. While it's great for people to get into certain homes that maybe they otherwise would not be able to because they don't have the cash down, they have a guaranteed income, which is why they're able to underwrite a loan at 100% or more, specifically with the VA funding fee, where you're owing more than what the house is currently worth or what the purchase price really is at if you're getting into it for the first time with zero down. But that can kind of be a moral hazard. And it's not always great for the local economy that's around those bases where people are buying, especially if the average home price is being driven up artificially by government money and the local population doesn't have the diverse economic background in order to sustain some of those houses. And so you get a lot more disparity sometimes between some of the local populations. Malmstrom or Minot really is kind of a great example of that, because there's not a lot of other economic indicators there. I think for Montana, I'm pretty sure it's still true that Malmstrom Air Force Base is the largest employer in the state of Montana. And that means that Great Falls is often dictated by the amount of revenue that's directly brought in by the Air Force Base that's there, which is why you have a bigger disparity in the homes and the incomes of people who live and have grown up there, who live there, that aren't in the military. And so it's something to keep in the back of your mind that while sometimes it's great to be able to get into homes using a VA loan, and you should certainly take advantage of what you have available to you, it's not all, sunshines and roses and rainbows on the other side. There are some economic cost, some cost and benefit that goes into it. So while it's good for you, it may not necessarily be overall great for that specific economy, and might cause greater disparity that's there as well. So with that being said, I kind of want to jump into it. What I wanted to do is go into a little bit of the numbers, but specifically kind of how to use the calculator that they have on the website. But I also wanted to talk about why someone might look into doing this. And they talk about being able to pay off your mortgage in 5 to 7 years as one of the big taglines that they have. And there's person after person that goes through their training program to understand what it is that they're doing and how they're doing it. That is crucial to people being able to achieve that. And people are achieving that all the time. It may take longer. It could also take a lot less time depending on where it's at. And we'll talk a little bit about that as well. But it also kind of contradicts some of the gurus that are out there for financial discipline courses, your Dave Ramsey, Susie Ormans, those types that are talking about how you pay down your debt, how you organize your personal finances, all that stuff. And I'm not necessarily knocking specifically what it is that they're talking about, although I certainly have my issues with it. You can see from my previous podcast that I'm not necessarily the biggest fan of Dave Ramsey. But he's obviously helped a ton of people in the situation that they're in. But I wanted to talk about this specifically because this is another element where I diverge from his personal finance philosophy, because we need to learn how to use the tools, even if they're a little bit more complicated. Us taking responsibility for that complication and making it easier for us to follow along with it and to execute on it, I think drives us to actually take a lot more control over our income and our expenses. And once we start doing that, we're really treating our lives as more of the business that it is, and allows us to get after it and find vehicles that make things more efficient. In my mind, the big overarching theme of this is that HELOCs make your personal finances a lot more efficient. And the one key aspect to that is the segregation of your income. So income or cost segregation, where when you're bringing money in, there's everybody that's vying for your dollars, your attention. And for a mortgage product, for a banking product, for insurance products, you name it. That's why they bundle a lot of the options that they have. USAA is great because it does bundle a lot of those together to try to make things more efficient, but they don't always necessarily have the best home insurance policy. They might have some of the best car insurance policies out there. And not always, right? But they have banking. They have all of the things that you could think of to run some of your personal finances. They have it in-house, which should, in theory, make it more efficient to be able to do that. Well, in other cases, as you start cost segregating out, well, a mortgage, it's taking money away from you that you're not able to use anymore. And so I've seen everything from people paying down mortgages where they will say, if your goal is to pay off your house, and that's a great goal. And I think it is a primary goal of why we would do a HELOC. But I think there's other advantages and other goals that kind of come along with that. If that's the first goal, I think that's totally fine. But there's other options that are out there where you could pay every 2 weeks. That way you're getting essentially an extra principal payment throughout the year. You could pay it as if it's a 15-year mortgage and get it down to basically paying it off in 15 years. That 2 weeks typically cuts about 9 years off of it. So you're looking at about 20 to 22 years. You could pay extra principal payment like as an equal. So basically you're doubling the principal payment that you're doing there as well. And that's actually one of the examples that I used that we'll get into for a comparison, a cost comparison of why I think this is more efficient. And let's see what else. So you can also use your tax return. So depending on how large your tax return is, you can put that against principal as well. So all of these things are certainly going to pay your mortgage down faster. And I think we all probably could agree that that is a good thing, especially when it comes to your primary home. And that's also key, primary home. If it's an investment, you got to love debt, because you want to make sure that you're buying properties at a deep enough discount that gives you the cash flow if you're doing a buy and hold or whatever. And we can talk about all kinds of investing strategies later on. But one of the things that I always go back to is Robert Kiyosaki asking, is your house an asset or a liability? And if you were to treat yourself as a business and write all the financial statements that come along with that, you would eventually find that while, yes, your house has some equity in it and it is growing in equity, which is a good thing, it is going in a positive direction. That's awesome. It's also dictated by the interest rates rising. So there's something that's outside of your control that will cause your local market to go up or down. There's a lot of factors that go into running comparables for home value that you don't really control. And it's a misnomer to think that everything is going to keep going up. I personally think the crash is kind of around the next corner. 2023, I think we're actually going to see a pretty significant crash in the economy overall. And I think it's going to have some pretty significant and deep cuts into the real estate market as well. I don't think they really have an option. They're trying to get inflation under control as much as possible, but they're going to possibly do it and raise rates. And I don't necessarily think they're raising rates fast enough, but essentially, like, they're terrified of also crashing the economy. So they're trying to get inflation under control, but inevitably they're trying to do it without crashing the economy. Well, crashing the economy will bring rates down eventually, but it's a normalization. And the thing to think about when it's not the crash that is the problem in a market cycle. It is the boom. And that is one of the fundamental aspects of Austrian business cycle theory, the Austrian economists. And what they explain is that if you look at it from a drug user's perspective, the high that you get as you go back to it, you have to take more and more of the drug you're taking in order to get to that same level of euphoria, that same level of high. Whether that's alcohol, whether that's hard drugs, you name it, you have to consume more and more in order to feel that desired feeling. But inevitably, there's always the crash that comes down on the other side. But what is the crash? The crash is your body trying to normalize and find a homeostasis and a healthy version of where it's supposed to be, because it knows that you're not supposed to have all the alcohol or everything else in your body, even though that gives you the great feeling and shuts down some of your receptors for things, which is why we feel those highs, why we get some of the dopamine kicks and all those types of things that come along with drug use. Well, if we do too much of that, we're going to have the crash. The crash is us healing. And the same thing is true from an economic standpoint. Depreciation is not a bad thing. I mean, inflation and deflation specifically is not a bad thing. Deflation is not bad when it comes from technological advantage. I mean, I just saw a 85-inch big screen TV LED at Costco for $1,800. I mean, my goodness, the amount of technology that has come in, when you look at the overall cost of that, it is a deflationary cost that has gone into those things that has driven the price of TVs down, and largely because TVs, for the most part, are unregulated, right? I mean, it's such a consumer product that people are always buying. Their TVs are always getting better and better and better and better. Whether you would even notice a difference 5 years now to now, I don't really know. But the price of those things are also coming down. That's a natural type of deflation that comes with economic progress in those specific sectors. But when our economy is based on debt, in order to do that, we're going to have a large crash that comes down on the other side. And that is healthy. If you're in a real estate investor, that's also a good thing, because it means that there's going to be some other deals and we can get properties that are misallocated currently and are far overvalued to get them back in proper position of where they should be from a value standpoint, and actually add and create value, not just on paper, but actually putting value back into that property and updating it and making sure that it's a great place for somebody to live, whether it's a rental or whether you're going to go sell it on the other side of that. It's putting better economic use back into those local communities, one house at a time. That's why I love being a real estate investor and why I love the current job that I'm in. Now, as we kind of head off into this portion of the crash, we also need to think about how efficient some of these other things can be. Because if you're stuck with a VA loan that's basically valued for the loan at 103% of the value of the loan, depending on how large that loan is as well, and you're trying to pay it down, well, you might find yourself that your home value is rapidly depreciating with that. So how do we speed that up? Well, one of the things that we can do, so long as we have the income coming in, is being able to pay that down more. But the biggest problem with having a mortgage in general on a property that you live in as it's going down is you, number one, can't control the value of the home on the outside other than maybe putting a little bit of sweat equity into it and trying to add value in that way. And the pay down that you have is great, but you can't access that money. It's going to get harder and harder to get lending as we kind of go into this situation. If anybody remembers back to the housing crash of 2008, I mean, the lending standards basically all came up and they weren't doing any lending for a while. Well, there's going to be private lenders and other avenues in order to do that. Well, one of the things that you could do is get into a home equity line of credit that is performing at the rate that it needs to be. The one caveat that I'm going to put here is no matter what you do in order to pay off your mortgage or whatever, this isn't always the best strategy for someone that has a poor credit score. It's not the best strategy for someone that doesn't have any margin whatsoever. Now, I know that even though you can still have margin and still essentially live paycheck to paycheck and just have things come up. You know, that's why a lot of the gurus out there will talk about putting 1,000 away for, a rainy day or some emergency. And that's all well and good. I think that's a great advice for someone to have. And then to start paying down the debt. That way you can create more and more margin. My only contention with it is that as you pay down more in your mortgage or pay off your debt to create more monthly margin that you have, one of the things that I think people are overlooking is that financial discipline you get with reorganizing the pie that you have and making it more efficient is the same energy it would take to increase your pie. One of the things that I always talk about is I think it is more important to find ways to reinvest in your knowledge, skills, and abilities to make yourself more valuable to the marketplace. Now, if you're in the military as an active duty person, that's not always an easy thing. It's one of the reasons why I went into a sales role that's a commission-based job, because I have a lot more control over the amount of income that I'm going to get. Even if you're in a W-2 job where you're gaining a salary, I always recommend looking at finding, not necessarily a second job, but some sort of side hustle that you're willing to pick one thing to get really good at with it to try to make money off of and stick to it consistently every day for an hour and do it for 90 days and see where you're at. And if it's not working, then maybe pick something else and look for something else, because it shouldn't take more than 90 days to start looking and seeing some sort of income coming in. And even if it's just a few $100s, hey, that helps. In some cases, you can make enough that, it basically replaces your need to go take a part-time job, because you're making enough with maybe an extra hour a day or 2 hours every other day in order to increase that overall income. But the return you get on that is much, much higher than simply just paying down the debt that you're going to have. Not saying that you shouldn't pay down debt, but I would prioritize your capacity to earn more income over paying off the debt. Now, once you figure out what you can pay, that's great. And I'm not saying that you need to pay a whole bunch of money into courses and everything else. There's so much out there for free. And because it's free, you're getting an infinite ROI on the knowledge and skills. It's just you have to take the time and energy to pick one thing and to be consistent with it day in and day out, week in and week out, depending on what type of business model that it is. That's why when I talk all the time, if you get on my email list or you look at any of the posts or my social media, I always will have something out there that's in affiliate marketing. Yeah, sure, I get a kickback from it, but it explains how to do affiliate marketing with systems that are already built. So you don't have to build all of those things, because it's going to take a learning curve in order for you to build a brand and to get things out there. And there's some ways that people have been in the industry that know how to kind of hack the growth up front. And it's a great tool to be able to use, but it's a minimal investment for a huge potential payout. Now, not everybody does well. Honestly, most people that even get free information or pay for those types of courses, honestly, there's probably less than 10% of people who are making money. And it's not, in my mind, because people can't make money from it. It's because only that many are actually taking action consistently. They're focusing on one thing consistently day in and day out to get those results. If you're doing all the steps that the courses lay out for you, you should have some level of success, not making no money at all, but making at least some money that you can refine and figure out how to make more money as you go along. So again, it's very, very important to do that. All right, so let's get into, so we talked about paying some of those things down, why you can't control what it is, and you can't get that money out of your equity, even though you're on your business sheet, your financial statements, if you're treating yourself as a business, yeah, you're gaining equity, but it's not something that's usable that you can tap into. Well, a home equity line of credit, or even, if somebody has a business, the business line of credit is cash that's available right now for you to be able to use. So my recommendation, why I think the HELOC is superior to a VA, is because as you're looking at your overall financial picture, the discipline you have with it, it makes it more efficient because you can pay the amount that you owe, the principal down faster, while accomplishing all the other goals you set out to do. So I want X amount in savings for a rainy day. Just by converting to it, that equity you're now able to use because you're essentially using it as a checking account. And if you know anything about a checking account, if you have money in the checking account, guess what? For you, that's an asset that you can tap into. So as long as you have that margin, that the income and expense ratio, and the more that you can increase that margin, the more effective it's going to be. And again, you can pay off your mortgage if you want to, but you can't use it again unless you're going to go get a home equity line loan or a line of credit against it, or selling your house outright. And that's not necessarily the goal that you're going for. We're trying to just make this more efficient. So why do I think maybe a VA isn't the best? Well, I've kind of covered a little bit of that about why you can't get it out and why the amount that you owe isn't always the best amount. The thing I want you to think about is when you buy a home if you're an active duty, or you married to an active duty person, or maybe you do tend to move around a little bit more than the average person. You haven't quite settled down where you're at yet. Well, the bank makes 50% of the interest it's going to make in the first 5 years of a loan, of any mortgage that it has. And so they're making out like bandits, where at 2 or 3 years, you may not even be back to what you originally purchased that home for. And that's part of the problem with the VA loan overall, is because you're moving out, you have almost no choice but to hope that the appreciation you've gained on it is enough to cover the amount of selling the home, plus the cost of paying commissions and closing and everything else that comes along with it, and paying off the mortgage that you had as well. If you plan on staying in a place for a very long time and you buy a home and it's everything you want, I got no qualms against that. But I still recommend looking into a home equity line of credit through the Replace Your Mortgage system that teaches you how to make it more and more efficient. So with that, let's kind of get into it overall. So actually, before I do that, let's talk about where VA might be fantastic. And it goes real simple, and it deals with thinking about things as an investor. So sorry to kind of dovetail into the numbers and then go this way. I think a VA loan is great if you are learning and becoming a savvy investor in a sense that essentially be house hacking, and you're buying a house and you're helping rent it out. You're living in it for the minimum period of time, or having the intent to live in it for the period of time. You're going to be moving in within 60 days of purchasing the property. All of the standards that go along with having a VA loan or an FHA loan. Now, when you house hack, it's a lot easier said than done, especially if you're like in my situation, where you're married and you have kids. Your spouse probably doesn't want to have somebody else living there. Now, if you're young and you're fresh out of college, or you're fresh off of your first or second assignment as an enlisted person, and you're not quite married yet, or maybe you're married but you're still young enough that you don't have kids or anything like that yet. Like once you have kids enter into it, I think a lot more of your protective space kind of goes into this, because we certainly had plenty of lieutenants and young captains and stuff that would be living in a duplex where, you had a couple of roommates in one side of the duplex and then a married couple in the other side of the duplex. That's a great way to go about it as well. Now it could be up to a 4-unit place as well that the VA would cover. And that's awesome. You can do a lot with that. You can maybe find a place if you are married where you find the main home that's there and it happens to have a mother-in-law suite that's on it. And if it's in a popular area, you can throw it on Airbnb, maybe check out and see what the rates would be and how much money you could make over time, and then manage it that way and run that sucker as a business. There's some people that literally could, depending on the area you're in, maybe Omaha is one of them where we lived, Jacksonville or any other destination type of places where you could literally rent out that unit and potentially even pay for the whole mortgage month in and month out based off of that income. So again, it goes back to the idea of, is your home an asset or a liability? Is it putting cash flow into your pocket? Not just gaining equity. Is it putting cash flow into your pocket? And so house hacking is one of those ways that you could do it. You could potentially, fix up one side of a duplex, move somebody into that one when you're done renovating it, move into the other one, renovate that one, and then refinance later on out of it. And that process could take 2 to 3 years or less, depending on what it is. So these are great ways to get into it initially if it's a VA loan. And then if you hold it for long term, even if you do like a VA refinance while you're living there, and then you end up moving away afterwards, well, it's still under the VA loan system. And that's fantastic. And you might have a great rate on it and you're paying it, for the next 30 years and it cash flows. That's fantastic. You can decide financially what you might want to do with it later on, depending on what the market's doing. You can go to revisit that in 5, 7, 8, 10 years, whatever the case might be. That would be one of those situations that I think a VA would be superior, because you're putting nothing out of your pocket and you're earning an asset from it. Your return is infinite at that point. I think you can load yourself up with as much debt as possible, so long as you're bringing in enough cash flow to cover the debt in their smart investments. That's where I think having that VA loan really does make sense, but it requires you thinking like a real estate investor and understanding more things about business. When I'm looking at the first lien position, home equity line of credit, it's not always people who are thinking in that mindset. It may have what kind of brought me to it, to even kind of consider it, where I saw Replace Your Mortgage was on, I think, a Bigger Pockets. It was on a couple of different podcasts that I believe that I listened to. I was like, oh, that's interesting. Well, my wife and I at the time were looking, hey, how can we pay down debt and pay down our house faster? And we got into the program. It just made sense to me. And now we're well on our way to paying the house that we own in Omaha and paying it down very, very quickly. And the more money that I make here, the more income and margin that I get, the faster that process goes, and the more money goes back into our pocket to do something like that. And we're treating it as a checking account. We live out of that account. And that's what's so great about it, is it accomplishes us paying off debt and putting money away for a rainy day, 3 to 6 months worth of expenses, all in one place. And because we're not putting our money everywhere else, earning interest for somebody else, it's making our overall debt picture a lot more efficient. So even as we're paying off, even as we're paying the minimum payments on things that might even have a higher interest rate, we're able to pay this down a lot faster in order to encompass that. So it's a net wash when it comes down to being able to do something like that. We could pay more money going into that month in and month out, but the more margin that we create now and pay that and then dump that back in and snowball all of it back into that, the more efficient it makes the Heloc and the home equity line of credit. And that's the overall big picture. So I want to share my screen now and talk a little bit more specifically about the numbers. And I have a couple of kind of scenarios that I wanted to run through a little bit, just to give you at least some perspective on what it is. And I chose 3 at first, but I went ahead and just did an extra one just because. So let's think about it. I picked an Air Force person, or persons, Navy and Marine and Army. So I wanted to cover the gamut, since we're all, since I'm looking mainly at veterans, active duty, spouses, you name it. And so what I wanted to look at first, just because it's a little bit more of what I know. Now, while I was on the officer side of missile operations, I'm looking more at the missile maintenance side, having an enlisted married couple who is actually looking more towards the end of their career. They might be an E7, E6 married couple. They might have a couple of kids. They got into it. They're young. Maybe they had, some nice trucks and some other stuff. They were able to finally kind of pay off, and they've made this a career out of it, but they have 3 or 4 more years to go before they make it to 20. And they're in Minot, North Dakota, because they're missile maintenance. And overall, their annual net income after taxes is, they might be in a little bit higher tax bracket at this point because they've been in for so long, but you're looking at about $133,000, maybe a little less. Potentially, but that's a monthly income of about a little over $11,000 that's coming in. And if you go off of a 30% to 40%, maybe 35% is about what you can afford for a house. And I don't necessarily remember exactly what I rounded it off for. But I'm just, for their scenario, they were in debt, initially, and they finally got to a point through their career that they got a mentor, financial mentor, not necessarily someone in the military, but at least they attended, Dave Ramsey workshop or whatever. And they were able to actually pay off quite a bit of debt and get to the point where, their income, they're excluding their mortgage that they would pay for. And they're moving to Minot, North Dakota. They're looking at a house to buy at around $360,000. The one that I found is a 4-bed, 2-bath or 3-bath place at like 2,500 square feet right on the northwestern side. And, it's a great family area. People love raising families in Minot, even though it's cold as balls there, and it can get, pretty miserable through weather-wise through that, but people still love living there, love raising kids there, and build a lot of community. Well, so let's look at, the perspective of buying a Heloc versus a mortgage. So let's just say that they've been able at least to have 10% down on what they're going to be doing. So they have, $30K, $36K set aside. They put that towards the overall mortgage that they have, and their starting payment, in all honesty, it really doesn't matter how much they actually put down when they first start. It might save them 1% to 2%, 3% maybe on the VA funding side of it. So if you look at kind of the schedule, if it's their first use, if it's less than 5%, so putting nothing down, 2.3. If they're putting 0 down, it's 3.6. So those numbers go up, but it does significantly drop off at the 5% to 10% or more that people are putting down to 1.65%, 1.4%. So the big one for the first use or second use or any use after the first use is really the biggest difference from 2.3 to 3.6% jump that's there. And it's also the same for cash out like refis as well. So it's important to kind of take into account. So let's say that we have the 11,000 that they're bringing home. The expenses they have, I said 50%, maybe it's 60% that they live off of. So it's not quite where it is, but they have margin. They have, about $4,000 of margin that they've been able to do. Now, the margin that I'm thinking of here, again, it doesn't include the payment overall. So it's not necessarily 4 in margin. It's about 2 in margin when you really factor in the mortgage, but we're taking the mortgage out of it from living expense standpoint because we're replacing that mortgage with this. And so when you just look at it overall, and let's say they had, small percentage when they put back into it, I think it was 1 whatever percent off of 360 that they had. So they get a loan for 360. So they're still owing more than what it's worth at this point, even though they put a little bit of money down with it as well. But we're looking at the payment schedule overall. And down here, let's say their assignment, they're just now buying, it's 3 years or so. And they're down here and they owe now $274,000 left in the mortgage. Now, keep in mind, they bought it for 360 and they owe a little bit more on it than 360. But by the time 3 years rolls around, when maybe their next assignment is coming up, one of them maybe can retire. The other one has a year left. So they probably either have to stay there another year or they're going to be looking at moving somewhere else. Potentially, they have $274,000. They've paid almost $90,000 off in a 3-year period simply by using the efficiency of a Heloc and how the interest is calculated. And it's very different from an amortized where all of the interest is front loaded. Like I said, the banks, whoever's giving you the mortgage for an amortized schedule, they make 50% of all of the interest over the life of the loan, over 30 years of the interest that they're going to gain. 50% of that is earned within the first 5 years of that. So they're making bank off of that, which also means you're not paying your principal down nearly as fast as what you would pay if you had a different schedule, which is why this is so important because you're still paying it down. And if you still have the margin that's there, well, guess what? If they have that extra $2,000 that's still going in here over this 3-year period, 36 months, you're looking at out of 36 months at $2,000 of margin that they've been putting away, they're just putting it in their Heloc and living their life like they normally would. The only thing they changed about the way that they lived even after making financial mistakes early on and then working their way out of debt, and they only have this much that they live off of because they have kids, they have some expenses that are going $6,000 worth of expenses between food and sports and other stuff. I mean, that's still significantly just average, I think, would people say. I think there'd be a lot of people say that's cheap, man. And I spend $8,000 a month if I have it, especially with kids and everything else as well. But $2,000 a month extra at 36, I mean, that's, $72,000 that you've basically been able to dump into this thing of extra money that you've been able to put away into this thing. And that's rainy day fund. That's your 3 to 6 months worth of expenses. So if something does happen where you can't work, you have some of this to rely on, and it gives you time. It gives you margin to be able to make decisions about what it is that you need to do. And that's what I think is really so important about all of this. I think I do have the spreadsheet brought up somewhere. Let's see where it is. So we'll pause that portion of it. Yeah. So in total, you've paid about $69,000 in interest payments at this point, which is interesting, right? So you've paid that much out of this one. Well, let's look at, I believe, what it was for an amortized schedule. You've paid out at this point at 2024. So 3 years from the kind of the time, let's see, 1, 2, 3, from the time that we've done. So 2025, you've paid $81,000 in interest payments to it, and you still owe $351,000. So now you could pay more, and let's look at what that looks like. Let's go ahead and just pay what it would look like about the amount of interest you pay. This is not paying anything extra. Maybe you take that, $72,000 and you put it aside into savings, into investing, whatever the case is. Or maybe you decide to double up the payment and just dump as much as you can into it because you want to just get the payment down whatsoever, as much as you can. So let's look at the monthly payment here. And what we're going to do is double that monthly. And that sounds crazy. And I don't think anybody is really doing that would really have the margin, but that's for kind of what it is. And I want to take a snapshot here as well to kind of talk about this. You're paying it off in about 114 months with this one, which if we do the math on that, you're looking at about 9.5 years that it's going to take. So nine years and 6 months of paying off at the current level that you're at. So that's pretty dang good for being able simply to change what you're using your checking account as by replacing it with a home equity line of credit, using it as a checking account and replacing your mortgage with it. I mean, it's incredible that the only thing you've changed about your life is that. And there's some other things that need to kind of go into it, but it's really that simple. And there's other things that you can do to make it go faster by being more efficient and using some other techniques. Those are advanced techniques that they go into depth with in the course itself. But when we look at this, 1, 2, 3, 4, 5, 6, 7, 8, 9 years as well. So maybe you're paying it off a little bit faster by doing this, but you don't have access to the extra money now. So yeah, maybe you save $72,000 on the side. You still owe $351,000 on it. So if you go to sell it and you had a market that depreciated, that was declining, now you may actually have to bring a lot of money to the table and eat into that savings just to pay it off if you decided just to save that money or invest it. Now you might have to take money out of investments in order to do that. And the thing is you can still pull some of that money out as you're paying it down and use a portion of it to go into some of those investments as well. I mean, there's a lot of options that come along with being able to do the home equity line of credit. But the thing that I wanted to point out here was at that 25-year mark, you've paid $70,000 in interest as compared to the $69,000 in interest. So it's roughly the same, maybe $10,000 difference or something like that, I guess. No, sorry, it's almost exact same. So at that 3-year point, 70,000 versus 68, 69,000. The difference of you doubling your mortgage principal payment every single month is what the effect that this is having, but you still have access to it. You still accomplished all of those savings goals that you've had for yourself. And you can even maybe at this point look at what investments you might have. Maybe the job that you have lined up after you retire is actually going to increase your overall income and allow you to pay this down even faster. You know what? Let's take a look at that real quick. So let's say, for example, let's go back one, probably have to go forward. It should still have all the same numbers for us. Let's go. Let's do it. All right. So it still has the same numbers for us, but let's say it cut it in half. So now you're getting half of the pay that you normally would as the first person to retire. But, the spouse still has to stay in. They're still making the amount of money that they are making. But let's just see kind of what the overall payment would be. So bear with me just 1 second. So we're looking at an annual taxable income. So your base pay, since that's all you're actually getting it based on. And I'm not going to do refigure all of the BAH rates, because obviously the spouse would now be able to claim dependents, at least for the following years that they're in the military. They would be able to now switch over dependency and raise their BAH rate by claiming dependents. And so that's that's a good thing. But I'm not going to factor that in because it's kind of marginal as far as what effect that would have overall. But you'd be able to earn about $5,000 in retirement at this stage, retiring as in E7 in Minot. So your base pay is around $60,000. Well, sorry, let me redo that. So it's about $60,000 a year. $5,000 in base pay is about what you're getting every single month. So if we cut that in half at that 50% level for it, assuming you didn't opt into the BRS system for blended retirement, but you'd be at $2,500 a month. That would be what you'd be making. And so when you factor that in, let's say that you're able to get a job that essentially replaces the income that you have, or maybe even make a little bit more take home pay. So instead of getting $5,000 a year, you now get $6,000 a year from a government contracting job, or maybe you go work for a local firm doing, whatever was kind of close to what it is that you were doing. So that $2,500 in retirement that you're getting is now with that additional $6,000. So now one person is bringing in the $8,513 plus the other. I might even be more than that. I might have done the wrong one. Whoopsie. I can always just edit that out later if I feel that I need to. So I did the wrong one, and that's okay. So what we're looking at is we're taking the annual income or the base pay of the individual, and that was actually correct. So it was the $5,000 base pay, split that in half, and now we're at $2,500 a month, and they're earning an additional amount on top of that. And then we're looking at overall kind of take home pay, so 60,838 divided by 12. So the other one also earns about $5,000 while they're still in. So this does include the BAH and everything. So we're going to add the $2,500 in retirement pay plus the $6,000 of take home pay that they now earn. So now we've actually gone from having $11,090, and after that portion of time, let's say, so where would we be? So let's take, for example, this is where we were at. And now when we factor out, so let's go ahead and just change this real quick. So 13,569 is the new number. Their expenses haven't changed at all. And now they actually owe less money. And we said that they pulled out $69,000 in interest, but they now are at $274,000. So when we look at this, we're actually now reconfiguring it. So it's been 3 years at this first level, and now we have a retirement pay and they've paid this down now to $274,477 is what they've paid it down at. So now that he's increased his income after paying it off for 3 years at that rate, so has half of the retirement pay, 50% of their base pay from when they're high 3 or whatever the case is. And the spouse is still in, she's, he or she's in her last year of active duty, if that's what they decide, or maybe they're going to stay longer. Who knows? Maybe they're going to get a pay bump here soon and continue going because maybe they're in a different career field or whatever the case is. And now we have a new job on top of that payment. So we've gone up to $13,500 ish. And we've also paid off that. So instead of now taking 9 years total, it's been 3 years. Now, just because they've increased the amount, they've retired and now they've gotten another job to increase their overall income, and they're still using this strategy. They went from being able to pay it off at 9 years at the current level they were at to now being able to pay it off in 7 years instead. So now they've cut off another 2 years of being able to do that simply by changing. Now, if she decides to retire and makes even moderately the same amount of money plus the retirement pay, now we're looking at even faster. It's probably going to take, another year at least off of this total span of time that's been elapsing. So it might take 6 to 7 years simply by being able to increase their overall margin by doing so, by earning more income. And that's not including a side hustle or anything else. And so that's kind of an in-depth example that I kind of wanted to get into. And then I wanted to jump to a couple other examples. So I went to an officer, so an 03 in the Navy that happens to be at Naval Air Station, Jacksonville, and looked at a house that person could probably afford. The annual amount that they're bringing home is about $87,800, about $88,000 per year that they are bringing home. And that gives them the ability at 35% to buy a house with a mortgage to include the taxes and interest or insurance at $2,500, $2,600 ish. Not necessarily looking at BAH and what that covers, just saying from an overall standpoint of a monthly, that's kind of about where it would be if we just based it off of their personal finance. And if we end up buying a house, and I chose one that's about $260,000, somebody that might be deploying a lot, flying quite a bit, flying I believe the P8 Poseidon that's out there, and maybe they deploy quite a bit. But they're getting here for this assignment. I say captain, as a lieutenant, Navy. And, they have monthly expenses. They keep them, fairly low, about half of what they bring in do they actually spend. So net monthly income, about $7,300, spending about $3,600 on a mortgage that they owe $242,000 on, that they got a first, looking at 10% because they're able to refinance at 90% of their interest rate. So maybe they were able to bring in about 10% of the purchase price to this, or evaluated it at a point where they could bring in 10%, or at least account for 10% of the overall value of the home. And so now they're able to get a HELOC at this rate. And so if we look at it and kind of where this rate goes, one of the things that we can do is look, okay, if it's a 2-year, 3-year assignment, whatever the case is, we can simply look at one good metric is to simply look at the $153,000. So they went from owing $242,000 to now paying down $153,000 is what they currently owe. And then if we factor in simply the overall interest rate that somebody has paid here, and I'm just doing a quick editing and summation of the numbers of interest over that period of time that they owe, we now get to a point where, oh, come on. $41,000. So they pay $41,000 overall in interest payments over that period of time, but they've gone down all the way to $153,000 at that 36-year mark. So I guess they've paid a little bit more in interest there, maybe $43,000 or so, but without changing anything. So they're not changing. And again, they're not changing anything about their life. They're literally just using their account as a checking account. Their HELOC is now a checking account for them. And you can go to the same place. This is replaceyouruniversity.com/calculator/HELOC calculator, HELOC calculator. Or you can just simply type in HELOC calculator, replace your university into Google, and it'll bring it right up. And then I went on to a civilian. I'll come back to that one. So I went to an E5 Army that did special operations, special forces, Green Beret out of Fort Campbell. And so instead of living in Kentucky, this person decided to live in Clarksville, Tennessee, on the other side of the state border, since Fort Campbell is right there. And, as an E5, you bring in the net annual income after taxes at about $54,000-ish dollars. And gives you about, the affordability of, $1,594. And so you can buy a condo. Some of those can qualify for it. Maybe you buy an older house with a little bit of acreage somewhere else. But in this scenario, I just said, a $200,000 house would be sufficient. And you bring in $6,000, you spend $3,000. So again, you're deploying a lot. And the one thing about this one is because you deploy a lot, you also probably get a lot of tax-free income coming in as well. So even though annually you might only bring in that 54,000, that might only be 4,500 or so. I'd said, they might be able to get an extra $1,500 a month simply because, a lot of their income on average isn't getting taxed because they've deployed and they're in a war zone somewhere, whatever tempo that might be at, because they're, gone or whatever. They play the game of being deployed over, the span of 2 months simply by being able to go out for a week in between when months change over and taking advantage of that kind of tax loophole. But when we're looking at it, we got, payments that are coming in, and it's going to be about the same kind of thing. I mean, after 36 months of this assignment, you're looking at $127,000 that you owe. And again, I'm going to keep reemphasizing, you're not changing anything at all about how you live. You're simply using the margin that you have that you would already been doing something with, whether that's saving it, whether that's maybe investing it. And if you have debt and you need to pay stuff down, well, maybe your monthly income also incorporates your ability to go ahead and put enough money away. Maybe you put 10% away of your gross income in an IRA or a Roth IRA or whatever the case is. And then you factor in what your monthly expenses are after that. You could also take that into account when you do one of these calculators and still be able to do that. Because again, you're simply by bringing all of your income into one place and use your home equity line of credit, your equity, as a checking account, you're making things more efficient over time. You're taking advantage of your money being in one place, and you're taking advantage of the efficiency, even if the interest rate of your HELOC is more than what it would be for the mortgage, which they typically are. And even as you have increases and stuff and it goes up, one advantage certainly to a mortgage is you're locked into the rate that you're locked in. So people at 3% rate it's fantastic for them. And maybe I'll do that at some other point to compare what a lower interest rate would do in comparison to a HELOC. But because you have margin and your focus is on increasing margin and paying it down, it becomes negligible, because rather than thinking about how much interest you're getting charged over a monthly period, day to day, month to month, we're looking at the totality of us paying it off in that period of time. Because even if you pay it off in 5 years, remember that even if it's at 2% or 3% of a mortgage that you've locked in your rate for 30 years, they still make 50% of the amount of interest that they're going to make, which is profit for them, is going to happen in the first 5 years. So in the time that you're paying it off with a HELOC at a higher rate, they're still earning at least 50% of the overall interest that they're going to make over that 30-year period and that 5-year period. That's why it's negligible as far as what it is that your interest rate is, so long as you have the discipline. And that's the whole point of calling into booking a call with Replace Your Mortgage and having one of the guys walk you through, and they'll look at your finances and see whether you're a good candidate to actually move into the process. A lot of it is just education, what it is that you could do. Because if you're just not a good candidate at all, they might give you other resources in order to become a good candidate. And that way you're not paying a whole bunch of money that you don't necessarily have, because it is a system that you pay into, because it's a lot of knowledge all condensed into one training platform that teaches you how to go out and find the right HELOC for your situation. But if you're not, going to be able to really close on a HELOC in the next, month, 3 months, 6 months in order to do that, they might have you hold off and actually give you some other resources in order to get to a point where you can make that decision and you have margin. Because if you're just living paycheck to paycheck, you don't have a great credit score, you're underwater and stuff, you might have some other issues you need to work out first before moving to this. And I know a lot of people might find themselves in that situation. I know my wife and I first really found ourselves in that situation. And we were able to pay off quite a bit of debt very quickly that made us eligible for this program. And that was way back, 2015 and 16 when we were really doing it. And it took some time for us to really pay down some stuff before we even considered looking into this. So I'd heard about it and had to wait a few months before I even got into the program itself. So that's certainly doable, but that's part of the pathway. The last one that I wanted to look at was just somebody that was a former Marine. Maybe they spent 10 years in, and they did a lot of fitness stuff there, had maybe a business on the side where they did bodybuilding or whatever. So they really wanted to open a gym. So they left the Marines, moved to Nashville, opened up a few gyms, and really, really became very business savvy. So they make sure that they only keep, they actually make $85,000 of take home pay, but everything else, all the nice, the truck and everything else is all owned by the gyms, by the business that he has. And so a lot of the expenses that they might have, they're very, very, very savvy, and they're making sure they don't make more than $85,000 or $88,000 specifically to stay under that tax bracket and to stay in that tax bracket as long as possible to be able to have, enough money. So their expenses are super, super low. And even with that, because their expenses are low, they're able to actually enjoy some of the things. They actually can put money aside, go on vacations. They might actually be able to live off of like $3,000 a month because everything else the business essentially pays for, because it's a lifestyle for being, a trainer. And so they might have a few gyms that they own, and the 80,000 does not reflect the amount of money that they're actually probably able to pull in owning a couple of gyms, maybe 2 or 3 gyms in an area, but also running a successful practice as a personal trainer as well. So that's kind of where I'm coming from to look at it. They might be able to bring a lot more, but they're reinvesting a lot of that money back into the business, but also taking advantage of many tax deductions as possible. So $300,000, maybe they want to move into a really, really nice swanky place later on, but they're not ready yet. So they have a $300,000 place they're moving into. Maybe they want to work on it and do some other things with it. But in this case, they make $7,000 a month take home pay, $3,000 in expenses for a $300,000 house. Again, you're just looking at this 3-year point. You're looking at $207 that they've been able to already pay off. So almost $95,000 they've been able to pay off. And in this case, they're paying it off. They're on track to pay it off in about 8 years. And that's pretty awesome. And that's not including like if they were able to, put some of that stuff back into it. But that's kind of where they're at. So with that, I really want to make sure that you guys, you'll see the affiliate link that I have. I'm going to stop my share here. So I know I talked about a lot. I maybe have rambled a couple of different things. But I want to go back to a couple of points. It's always, no matter what you decide to do, increasing margin is always important. And while you can increase the pie, or you can divvy up the pie differently and pay down debt to increase what you're bringing home, it's still as much discipline and as much effort needs to go into increasing your income in some way. So I always encourage you to think from that perspective. Second, I always think about encouraging you to think like a business. What is an asset versus a liability? This is why I think the Heloc strategy is a much better strategy, because you're treating your equity like a checking account. Rather than putting extra money in, you'd have to put double what the principal payment is, essentially to equal about what it is that you're doing. The key is you have access to that checking account. It's as if you're saving and paying down all from one account and making that whole process a lot more efficient without changing your lifestyle, without changing what it is you're doing today. As long as you have margin, you're able to pay that down. You're not changing the expenses or the way you live. So that's the second thing. And the last thing I want to say is encourage you is, the VA loan can be great, but if you're coming at it from an investor perspective. So if this is your house, if you're married, have kids, I think the Heloc strategy is one of the best strategies to have throughout this entire thing. So you can find the link for my affiliate link. And yes, I do get paid from this. Again, increase your income, do whatever you can to do it. But I wouldn't be also giving you something, even if I'm profiting from it, I wouldn't be suggesting something that I haven't paid into and that I haven't been partaking of in some way, that I haven't gained something from. But this is an active strategy. Part of the cash flow veteran business model that I talk about is using this strategy with Replace Your Mortgage, Replace Your University. So with that, you'll look for the affiliate link if you want to get more information. It's no obligation, no sweat off my back if you don't buy into the system or anything like that. I just want to give you as much value as I possibly can and have you keep coming back and maybe providing even more value to the veteran community, the active duty community as a whole, to make sure that we are finding financial independence and financial freedom. As much as we're fighting for political freedom and everything else for other countries around the world, maybe we should get a little bit of that freedom in our pocket and in our homes. All right. With that, we'll see you next time. I'll be on this bandwagon a lot more often now that I'm finally settled in. Got the kids settled in, kids in school, wife, new job, me, new job, moving on. All right. We'll see you next time. Take it easy.